In this week's tutorial, we're going to look at a question called goal limited. So again, this is a standard enough IAS 1 question where you're given a trial balance and a number of adjustments that you need to work through. And we're going to work our way through them then. And in this case, we're asked for three financial statements. Statement of profit or loss and other comprehensive income, statement of financial position, and statement of change in equity. So again, the first thing you always do is check how many statements you're asked for. In this case, we're asked for all three. And as you go back up along here then, you have a look down through the trial balance, note anything that might be unusual, because you might have to come back to it. And then you look down through each of the notes and note anything again that's unusual. So what we're trying to do here is get a sense of what the overall question is about before you jump into it. And remember, have in the back of your mind now, there is a statement of changes in equity. So anything you know goes in there, you might label it as you go along. So if we go down along, you've had a look at the trial balance. You're saying, is there anything unusual that I might have spotted? Well, firstly, we have an interim dividend. That would be a dividend paid halfway during the year. I'd put a flag beside that. That would be statement of changes in equity. So your ordinary dividend always goes to statement of changes in equity. It does not go to the profit or loss statement. It's not an expense. This is retained earnings at the end of last year. So I'll highlight these in a different color just so we're flagging them. Remember, this is 18, that's 17. That's the opening retained earnings. You'll be amazed the amount of students who put that figure directly in to the statement of financial position. This is 12 months later. You need to update it. Debenture interest only for 6 months. So where's the other 6 months? And we know debentures have 10%. So that should be 10,000 interest. There's only 5,000 in. Right, so we have to look at that. Your bank, be careful, is on the credit side, which means it's an overdraft. Did you spot that? We then have discounts, both sides. You have to figure out which one is discount allowed, the expense, which one is discount received, the income. Then the rest of them are fairly straightforward expenses. This is opening inventory, just be careful. Sometimes closing inventory can be in there, depends on the question. And all the other relevant line items seem relatively straightforward as you go along. Right, but do that at the start of every question. Just look through, mark a couple of items you think, God, I might miss that again. So mark it up now. And have a quick look through each of the pieces, additional notes to the information. Just you're linking it back to particular elements in the question. What we're going to do is we're going to go through and give the journal entries for each of these adjustments initially. Because remember, if these are outside the trial balance, to bring them in, you must give a debit and credit. Otherwise, the trial balance will be unbalanced. And that's one big mistake a lot of students make every year in this module is they'll make one adjustment for inventory, but then of course the financial statements aren't going to balance. If you're bringing this in, it must go on the debit and the credit. So we'll look at journal entries because they are heavily examinable as well. You need to be able to give journals. So you're told your closing inventory was 250,000 at the year end. I'm just going to call that working one and put it, and we'll use Excel for this, journal entries, call W1, debit inventory, which is a current asset, and we're going to credit cost of sales because we know closing inventory reduces cost of sales, 250,000. 250. So if you're asked for journal entries, please do give them as a working and make sure you label them as well, because then it's easier to find and follow them when you're doing your workings and double checking you have everything in. So that's bringing in our closing inventory. It's an asset at the year end and it reduces our cost of sales. So the next one we're looking at then is depreciation. We have three different types of depreciation. Property, which is just 10,000. So it's a nice easy one to start with. Debit depreciation in the SOPL, credit accumulated depreciation for property. 10,000, 10,000. Increase your expenses, increase your accumulated depreciation. Right? So that's an unusual one where they don't get you to calculate it, they give it to you directly. So the next one we have then is furniture and equipment, 10% on cost, motor vehicles 20%. So there's no reducing balance here, both these are straight line. So furniture and equipment, we'll just copy this down. We now have depreciation again, and we have accumulated depreciation here now for F&E, furniture and equipment. It's 10% on cost. We know our cost here from our trial balance, just make sure you read it carefully, is 300,000, so 10% is 30,000. So 30,000 depreciation there, which is 300,000 at 10%. And finally then, the last one, which we're told here is motor vehicles. and you're told that's 20% on cost. So 20%, if we look at the question, is 64,000 divided by 5, multiplied by 20%, and that's going to be 12,800. So you have 3 depreciations. Do them separately. You can add them up if you want, but I just keep them separately so everyone can see where they're coming from. So your 64,000 multiplied by 0.2. Just be careful, if they said that was reducing balance, it would be a percentage of the net book value, i.e. you net off accumulated depreciation. So that can vary question by question, so always read it carefully. Your next one then is your accrued charges at the end of the year. This is a closing accrual of 17,500 for director fees. This means the expense has been incurred, but it hasn't been paid. So the debit and credit here should be debit director fees in the SOPL and credit accruals, which will be a current liability. Now the approach I'm taking is I'm doing all the journal entries first, and then I will present the financial statements at the end. So I have just a template set up here. Some people like to set this template up at the start and slot in figures as they go along. That may work, but sometimes you have to wait until you have all your adjustments done. So the more questions you do, you'll see what's the most efficient, but try not put in elements into the financial statements too early in a question, because otherwise you'll end up having to rub them out and start again. So just watch for that. There is a lot of adjustments that end up going into different areas of the financial statements. So you may be better off doing all your adjustments first and then slotting in as you go. At the year end, rate and insurance are prepaid of 9.4. What that means in rate and insurance up here, 9.4 of that relates to 2019. So that's a closing prepayment. So you debit your prepayments here, which is a current asset, and you'll credit rent and insurance expense. To say that shouldn't be in there, it's to do with next year. So take it out, credit the expense, and then debit your prepayment, which is a current asset. So they're basic closing accruals, closing prepayments that should have been covered in AF1, which is AC 120. So we're just refreshing your memory, and you should hopefully have done some of those previous questions to revise in terms of accruals and prepayments as well. So we tick those off as we've done them. That's fine. All of those are done. Debenture interest for 6 months was paid in January. So this is the 6 months that hasn't been paid. You have 6 months in. The other 6 months haven't been paid until after the year end, but they should be accrued because you have 10% at 6/12, which is another €5,000. The other 6 months interest. So debit what we call finance costs or interest expense, credit accruals, which again is current liability, interest accrued, 5,000. So that is 10% of 100,000 and multiply by 6/12. The first 6 of the months of the year are in there in the trial balance. That means they've been accounted for. The second 6 months aren't. And they've given you that note at the end. Even if they didn't give you that note, you would assume based on giving the 10% that you have to account for it. So watch for that. Because they tell you 10% debentures, you know the 10,000 debenture interest is not in there. Bank interest would be separate now, maybe on overdraft. Debenture interest is on this loan. So that means you know you need to record the other 6 months up to December 2018. The examiner helped you along here, giving you that. So here, in terms, a provision for bad debts needs to be established. So established means created for the first time. 2% of trade receivables. So if we look at here, our trade receivables are 192. So 2% of 192, we calculate it here, is 3840. So you're creating that for the first time. So it's going to be debit, bad debt expense, and you're crediting bad debt provision. And that will be netted off against trade receivables and current assets. 3840. 2% of your trade receivables. 2% of trade receivables. Hopefully that makes sense to people. You're then told in working 7, or in this case G, tax charge for the year is 82.4. You assume it hasn't been paid yet. If it has been paid, it would have been in the trial balance. So you just debit their tax in the SOPL, which is an expense, credit tax liability, which will be a current liability. We settle in the next year, 82.4. That's just your tax estimate for the year. It hasn't been paid, but you put it in as an expense because you incur tax during the year, but you have it unpaid at the year end, which means it's going to be a tax accrual, or you can call it a tax liability, is what we usually call it. Right, so again, you can see a lot of these workings are relatively straightforward, but you need to know your debits and credits to know where the adjustments go. Each of these has to adjust 2 places, otherwise the accounts are not going to balance. In November 18, the company declared a final ordinary dividend and it was paid in February. So we're assuming it was declared and approved at the year end. That means it should be accounted for, even though it was unpaid until after the year end. So what we say here, working 8, is debit retained earnings, because that's where dividends go, and credit dividend payable, because it's not paid until 2019, 20,000. Now, remember, put a flag there. That's in addition to the interim dividend that was paid during the year. So your final dividend will be made up, or your full dividend, should I say, of this one at the end of the year, 20,000, plus the 14 that we already flagged that was paid during the year. That's what they call an interim dividend. Both of those will go to the statement of changes in equity. Right. So that's our first approach, is do all the adjustments down and label them clearly. Some questions will not ask for journal entries, in which case you don't have to give them, but it's useful practice nonetheless because it allows you to figure out where am I making my 2 adjustments. If you don't make the 2 adjustments, your statement of financial position will not balance at the end. The other key working that I would always advise students here, 1 or 2 of them, is kind of aggregation workings at the end. So you don't have any big detailed workings on the face of the financial statements. You keep those financial statements nice and neat. So one of them that I put here is the expense working, where I tot up what should be in cost of sales, admin expenses, and distribution costs. So I do it here in columnar format, so I don't end up trying to do a big long working on the face of the profit or loss statement, and it ends up just being very messy and hard for the examiner to follow. So I slot in each of the items here, and I tot up what cost of sales should be, admin expenses, and distribution costs. Now just bear in mind here, you're juggling between 2 sources of information. You're checking are all the items in the trial balance included, and then you're checking are all items in the workings included. And get some system then of ticking it off or putting in a different color so you know everything has gone in. So once you have everything ticked off, you should be fairly certain that this thing should balance unless I've made a totting error. So we'll start here and we'll put in the obvious ones for cost of sales, which is opening inventory, purchases, and closing inventory. And we know closing inventory is working 1. So opening inventory, we know from the trial balance, you're told here, 225. And I'm going to put that in yellow to say that's gone in. And we're going to put in purchases, and I'm going to put that in yellow, 1590. So I have a system of ticking them off as they go in, so I know I've used each of these items. So 225, 1590. Both of those in. Closing inventory is 250, and that is your credit, your cost of sales. So I'm putting those 2 from the trial balance, and this one is coming from up here, and I'll put that in yellow as well. Right, just so I can see which ones I have already dealt with and I don't have to come back to. So that's your first 3 items in for cost of sales. We then go down through the trial balance and look at what other items are in the expenses. Right, finance costs are separate, we leave them out. We have discounts, so discount allowed is the expense, which is 17,000. See it here. And discount received is 12,000, which is on the credit side. Now I'm putting discount received as a negative expense, i.e. a credit reducing your expenses. If you wanted to leave in a separate line item, that's fine. Usually, unless it's a very material amount, we would net discount received against discount allowed. That's a debit, increase the expenses. That's a credit, decrease the expenses. But again, there's a bit of subjectivity there if you wanted to leave that separately. We then have wages and salaries, which are in the trial balance. Director fees, motor expenses. Director fees and motor expenses. All right, so wages and salaries directly in, 322. Be careful now, director fees. Hopefully some of you remember we have an adjustment up here for director fees. They are increasing by 17.5. So it's the trial balance plus working 3. TB plus W3. That's how I show the examiner that I know I'm bringing my adjustments in. So here, your director fees are 45 plus another 17.5. Right? 62.5. Right? So you can do that together or you can do it separately. That's fine. You can put it in here. It might be easier. Sometimes people leave that in the trial balance, just to be clarity, 45. And you'll come down here and you might just put in accruals, working 3, and you'll put in 17.5. Either of those are acceptable as an approach, as long as you show the examiner how you're bringing them in. So I keep the accruals separate just so people can follow, and that director fees is coming from the trial balance. Motor expenses, the same, 53. Rates and insurance, spell that right, I suppose, handy. Rates and insurance, I'm just taking from the trial balance. Be careful here, 43.8. But I know there's a prepayment, so I can do that separately. Prepayment, W4, and you could put in there minus, which is reducing your expenses, 9.4. So I'm taking that 9.4 and I've credited the rent expense. So again, you have choice there which way you want to do it. But you can put them in whatever way you want. If you want to net them off or you put them separately, just make sure they're included. Telephone and light and heat are the other two expenses. Telephone, heating and lighting, 16.4 and 40,600. So you're just totting those straight in from the trial balance and you're doing it all here. Now again, there might be some subjectivity. For example, here 53,000, you might put that over to distribution costs. You're saying that's to do with distribution, but I said that I'm not as concerned about where you classify them as long as they're in expenses. But that's generally the way we do it, is admin expenses and then distribution costs. But there is a subjectivity there if you wanted to put one the other side if you had a good rationale. Depreciation then from your adjustments. We have all our expenses done now in the trial balance, all done in yellow. Depreciation for property, depreciation for fixtures and equipment, and depreciation for motor vehicles. Property, 10,000, generally admin expenses. Fixtures and equipment. So we have debit depreciation 10. 30,000 for fixtures and equipment. 12.8 for motor vehicles. So put in our three adjustments. Highlight them in yellow to remind me of them in. That's 30,000. Motor vehicles, I would probably argue they might be distribution costs because they could be attached with delivery vans, etc. But I said that's subjective. So if you wanted to put those in admin, that would be fine. You'll get the same profit figure, you'll just have different totals on your expense items. So again, there's a bit of subjectivity there. We have our accruals and prepayments in. The finance costs are separate. Bad debt expenses does go in here now. Debit the bad debt expense, in this case 3840. Bad debt, that is working 6, 3840, and I'm putting that in the admin expenses. And that's your aggregation working done now. You have your cost of sales, the total, if you're using Excel, 1565, nice and easy, 524740, and 65800. And that allows you to slot those now directly into the financial statements and just cross-reference working 9. Instead of trying to tot all of those up on the face of the profit or loss statement and then it end up making a mess of it and the examiner can't read it, you can do it as a little aggregation working there. A kind of expenses table is what we often call it. The other key working that you might want to do at this stage will be property, plant and equipment. Now I have it done here already, but I'll explain it down through it just so we can work through it. You take the property, fixtures and equipment and motor vehicles and you just lay it out in terms of what the cost was, which is coming from the trial balance, accumulated depreciation, all of these items down, cost and opening accumulated depreciation. So that's not depreciation at the end of the year, that's the start of the year because you're charging depreciation during the year then. So 200, 364, and that means opening trial balance, 20,000 accumulated depreciation, 90 and 16. They're all reducing the debit balance because they're all credit balances here. So I have all of those in now and I cover them in yellow. So I don't double count them. What I want then is to take off depreciation during the year, 10,000, 30,000 and 12,800, which are the ones that I, for example here, sorry, I have charged in here. So this other entry, if we go up to the workings, that is credit your accumulated depreciation for each of them. That's what that negative figure is. It's increasing the credit balance, which is reducing the net book value. So we have those three gone in as well. So it's a nice simple one of ticking them off as you go in, so you're not going to double count them. So that means my net book value at the end of the year, which is what's going to go to my statement of financial position, is 170 for property, 180 for fixtures and equipment, and 35.2 for motor vehicles. So in total, and you can put this in as a single figure, property, plant and equipment, 385,200. So instead of trying to do all of that on the face of the statement of financial position, you can do it there in a summary format and just slot it in and cross-reference working 10. So I'm a big fan of doing those aggregation workings out because they really tidy up the thing and they make it easier for you then to follow and get that little system or methodology of ticking off things different color or even just ticking with a biro if you're doing pen and paper to make sure you have everything in and to make sure you don't put in something twice. So we have a good lot of the trial balance gone in and we have a good lot of the adjustments gone in already. What we're now going to do is the financial statements and we're going to slot in things as we go along. I have a template set up already just for the recording purposes. You may now set up the template at the start, or some people might do it at the very start of the question and slot in figures as they go along. Right, that's personal preference, which you think is the best strategy for you, but it's all about practice here. That's why we're giving you as many IAS 1 questions as we can, because it is a common exam question. Revenue, we've had no adjustments, so we just take it from the trial balance. So you go to the trial balance, your revenue, 2350. The benefit now of cost of sales, working 9, admin expenses, working 9, and distribution costs is we can slot them in directly. We don't have to do any detailed workings. We now know that our cost of sales, for example here, 1565. And I'm showing the examiner, this is important, that's in working 9. So I don't have to do anything else and I have that cost of sales finished. Instead of trying to ram everything in there now into a very small space and it not being very easy to read, it's very neat looking, and presentation marks are key as well in financial accounting. Admin expenses, we know are 524,740 and we know distribution costs are 65800. So you can lay them out like that. The other expenses is that you may have a different numbers, but as long as the total is the same and as long as you get the same operating profit, you'll still get your full marks. There can be a bit of subjectivity there around the presentation of or the classification, should I say, of expenses. So don't get too caught up on that as long as you have them in as expenses. Finance cost is a couple of moving parts here. We have the trial balance, debenture interest, 5,000. And we have 8,900 of bank interest. So there's two elements there. That's an expense and that's an expense. One is on the overdraft, most likely. One is on the loan itself, the debenture. But we also have another 5,000, be careful, from working 3. So you have to remember what the adjustments are. Sorry, no, working 5, debit finance cost, an extra 5,000. So that's in addition to what we already done. So if you wanted to put there, I'd be showing the examiner. If I'm doing my financial statements, I'd say there trial balance TB plus working 5 to show where they're coming from. So that is 18,900 as an expense, and your profit before tax now 175,560. But that's fine. If you have only a small adjustment, you can show them like that to show where the examiner where the figures are coming from. But certainly the bigger ones, cost of sales, admin expenses, should be done as a separate working to keep it as neat as possible. And it helps you in the exam then when it's neat and structured as well. Tax, we've already done. We've said tax is working 7. we know the tax expense for the year, to highlight it again, 82.4. So you expense that and you create a liability. So my profit for the year then is 93,160. 93,160. And remember, even if you don't get this perfect, there's still plenty of working marks to be gotten. It's not a huge amount of marks to get the perfect answer overall. We're looking at each line item that a student puts in that's correct. You're gaining extra marks. So don't give up just because you think you can't get one or two of the workings right. There's a lot more marks to be obtained. Non-current assets, we have an easy one here, working 10. We've it already done. That's the benefit of keeping it nice and neat. Go back to your journal entries, down to working 10. We said it's 385,200. And you put in a single figure. There's nothing wrong with putting in 3 separate figures, one for each one. It's going to be the same thing overall. That's personal preference how you present it. I just kept it as a neat single figure to slot in. Inventory is working 1. We know inventory is 250,000. You put in the subtotal to tot them up first. And we tot and put a yellow beside inventory. Debit current assets, 250. Now remember, my approach here is a bit more straightforward because I have the template already done. Yours is going to be a bit harder because you're working off a blank piece of paper. So you're going to have to slot each of those in as you go and try and figure out then before you tot up any section, do I have everything in? And that's where the ticking off is very useful. Trade receivables, we have the 192 minus the bad debt provision, 3840. Right, so that is going to be, if you wanted to put there, trial balance minus working 6. So you always net off the provision. And that's net trade receivables of 188,160. So that's coming from here. You're working 6, credit the bad debt provision, which reduces your trade receivables. And it's also coming from your trial balance, trade receivables and asset, 192. And those are put in now, they're in yellow, they're finished with. The final thing we had in current assets, if you go back and look, we had a prepayment for 9.4. The bank, remember, is an overdraft. That is on the credit side, so that is not an asset. That is actually a liability. So here, in our working 4, you have 9400. So that gets you total current assets. See the way we use one column to total them up, one subtotal to go across, of 447,560, and total assets 832,760. Right, so again, it's all about presentation here. The neater you have your workings, the better you have a system of going through your workings and the trial balance, the easier these questions become. But that doesn't happen overnight. That takes practice. And it takes you going back over questions as much as possible. Your equity, your share capital and share premium have not been adjusted. They're just coming here. Share capital 300, share premium 40. No adjustments needed there. 300,000, do it here, and 40,000. Retained earnings, there will be 1 or 2 workings, right? Remember I said at the start, that 85,300 is opening retained earnings at the end of 17. We're now working at the end of 18. You'd be amazed the amount of students who just slot in that. Right? You can't just slot in opening retained earnings. Retained earnings are moved during the year by dividends, the 14,000, and by profits. So it's the 85,300. You add on your profits for the year. Profits for the year, 93,160. So that's the link between the statement of profit and loss and the statement of financial position, less the dividends. Now there's actually 2 dividends here. The 14,000 interim dividend, which is in the trial balance up here, debit, reduces retained earnings. And you also have then in your journal entries a debit retained earnings 20,000, which is the final dividend paid at the end of the year. So it's paid after the year end, but it was declared before the year end. That means it's included. So that is here, if we do our working, minus 14, minus 20. So your closing retained earnings are opening plus profits minus the full dividend of 34. 144,460. And your total equity then is 484,460. Again, there's a bit of work there to make sure that you're happy enough where those figures are coming from. And no matter what your profit figure is, you will get full marks for including it if you do it correctly. So you won't get penalized twice. You lose marks initially for getting the profit figure wrong, but continue to use that correctly and you'll get full marks from there on in. Debentures, 100,000 from the trial balance. That's a non-current liability. Slot that off. Your bank overdraft is 72,000. Again, 72,400. Slot that off, and your trade payables are 51,000. So we've actually all our trial balance in then. So it's a handy thing to have it in yellow, so you get comfort that you have everything in. 72.4, and then 51 for trade payables. Now there are 4 other ones that you have to spot yourself. I just have the template set up so it makes it easier. We had tax, which is working 7, and we had the accruals working 3. So tax working 7 we know is 82,400. These should really be here. 82.4, and we had accruals of directors' fees 17.5. So if you come back up here, that's the accrual 17.5. Credit accruals increases accruals. Likewise, working 7, credit tax liability, that increases the tax liability. We've also an interest accrual working 5, 5,000. I'll put it in. Again, cross-reference working 5, 5,000. And then dividend payable, which is working 8, 20,000. And just double check we have everything in then. That's yellow, credit dividend payable, and that's all our adjustments are yellow as well, as are all our trial balance. So we can get some comfort, unless we've done a little totting error now and summed something up correctly, this thing should balance. We have everything in twice and we've left nothing out. So your total equity and liabilities then are going to be 832,760, which thankfully matches with the 832,760 that you have above. So that gives you some comfort that you are certainly on the right track. Doesn't always balance the first time, and you might have a bit of time to go back and see is there anything that you left out, but I wouldn't kill too much time trying to do that. Sometimes it can be a very small error that's not going to cost you that many marks. Right? It makes more sense to move on in terms of time management in the exam. So there are your first 2 key statements. Do your statement of profit and loss first. That then feeds into your statement of financial position. And the last one that you're asked to do then is a statement of changes in equity. Now this is a different format that it's going to be a columnar structure where the number of columns are dictated by the number of line items in your equity section. So in our case, we're going to have 3 columns plus a totals column. And what you're trying to do here is, as it suggests, you're trying to go from the opening balance at the start of the year to the closing balance. And you have your 3 items, as we have up here. So you have to do your other statements first. This should really usually be the last statement you do, and then the total. The starting point is kind of counterintuitive. You actually start with the closing balances, the 300, the 40,000, and the 144,460. So you start with the result from the statement of financial position. So you have to have the statement of financial position done first, and then we work backwards to the opening balances. So it's a different way of laying it out, but this is examinable, so it's important that students know how to do a statement of change in equity and what way it's laid out. Your dividends we have in retained earnings, they were minus 34,000. So be careful, that is the 20,000 end of year dividend and the 14,000 interim dividend during the year, which is in the trial balance. And we said profit during the year was 93,160. That's coming from the statement of profit or loss. So there's actually nothing new in the statement of change in equity. You're merely laying it out to show you where closing retained earnings came from. If there was a share issue, you'd have another line in there and split that between share capital and share premium. The other item that you might see in there is revaluation surplus from the revaluation of property, plant and equipment. But we'll cover that again later on in the year. So it is important that you understand what way a statement of change in equity lays out, and then you back into what the opening balance here. Not rocket science for these two. It must be 300,000, it must be 40,000, because nothing happened during the year. So 300 plus nothing is 300, 40 plus nothing is 40. For retained earnings, you work backwards. The 1440, take off the 93 that would have been added on, and add back the 34. So you're working in reverse to see, well, what figure here plus 93 minus 34 gets me 144, and it's the 85.3 that you should be familiar with from your trial balance. That is the opening retained earnings. So some students may use this column as the retained earnings calculation. That's fine as well. But there should be a consistency in terms of what figures are going into your balance sheet, what figures are in your statement of profit and loss, and what figures are in your statement of change in equity. So it's a relatively short statement of change in equity in this question, but you could have a share issue during the year, split between ordinary share capital and share premium, or you could have an OCI, which is a revaluation reserve. So it could be a revaluation loss or gain through IAS 16. But we'll cover that in more detail in subsequent lectures. So this tutorial this week looked at IAS 1. It looked at how to look at a trial balance for anything unusual, look at all the key adjustments, how to do debits and credits for each one, and then how to present a neat set of financial statements, clearly cross-referencing your workings, and finishing off a statement of changes in equity as well. So make sure you look over that and you're comfortable with those approaching an IAS 1 question.